And with that, if you could welcome Jonathan Wu to the stage to continue the conversation about fixed income and in Asia.
Thanks, Paul. So we've just heard about equities and where we view equities going forward. And usually, the fixed income manager comes up and talks about their strategy, and it's far more boring. But what I'm going to present to you today is far more exciting than what you're going to see from traditional fixed income managers. But as well as that, I'm going to challenge the traditional thinking that you have with fixed income. Out of the $15 billion that Value Partners manages, $7.5 billion or so is in fixed income, of which this fixed income strategy, our one in Australia, has been running longer than their flagship $7 billion strategy. And Gordon always likes to ask me, Jonathan, why isn't there more money in your fund? And I said, because in Australia, we like to use very traditional frameworks in order to decide how we invest in fixed income products. And that still stands today. But we are the largest fixed income, emerging market fixed income fund in Australia as well, at a very small $45 million in size. But we've got those 11 men and women running the strategy for us, and these awards that you see up on the screen here are only the awards that they've won in the last 24 months. And we keep winning the best fund manager, best high yield manager, best fund manager individually as Gordon. Then they have rankings for fund managers in the Asia region where they're consistently, 3 of them are in the top 25 out of about 500 managers. So there's a lot of consistency and pedigree in this team. And for those, advisors that use us, we thank you for your support on this strategy because it's very unique. But you would also agree that we've added a lot of value to your clients over 8 years. So the philosophy of the Value Partners fixed income team is really no different to the equity side, in which we're looking for value opportunities. So bonds which are trading fundamentally below their par value of $100, where we believe the market has dislocated their value to a level whereby we say we can add value because it's either not rated or it's sub-investment grade. And I'm going to dig into this, a fundamental fallacy in which we believe fixed income has been managed for the last, in modern portfolio theory, I guess. And the only difference is that we would be an activist fund manager in this space. Okay? So we will actively work with corporates to also restructure their debt, in which we would then take part and then participate directly in the alpha on behalf of your clients. These are all the different buckets that we invest in. Okay? But what you really ultimately need to focus on is pretty much most of it's high yield. We have up to 6 to 7% of the portfolio in distressed or in special situation debt. Now, that's not necessarily something to worry about. It is all very much contained risk, which I'm going to give you an example a little bit later on. And then we'll have a little bit of investment grade debt, which is about 3% of the market at the moment, but ultimately doesn't give you or your clients much value. And then we actively hedge the currency back to Australian dollars because we only ever expose your clients to one currency, which is the US dollar. Our universe is very large. It's about 800 billion US dollars in size, of which there's about 1,200 bonds covered over 450 different issuers. We then screen the market, and our target distribution yield for your clients, which I'm going to go into a bit more detail into how we actually derive that figure, is 6%. Okay? So every year we're trying to consistently pay 6% distributions to your clients. And after we screen the market for 6% bonds, then we end up with about 800 to 1,000 bonds with about 300 issuers, of which we then try to work out, is there any other catalyst above and beyond just simply taking the yield to then actually generate alpha for your clients? And then we start looking at the bottom-up credit analysis, which forms part of this here. As part of this, we believe that corporate governance is weaker in Asia than there is in most parts of the Western world. That's why you remove that risk by using us as agents to help you manage it through. So to give you an example, last year, Gordon had a very, very interesting opportunity to invest in a logistics company. So as in like a Star Trek Express or a DHL, and they were quoting certain numbers to us around the levels of logistics and trucks that were moving around China. We then hired 2 private investigators and placed them at 2 of their logistics centers, and everything they told us was rubbish. Okay? That's the level of research we go into to try to avoid the traps of a weaker Asian corporate governance framework. So we look at about 200 issuers in very, very minute detail, and it feeds into our scorecard. Okay? So previous to this, I haven't shown you this because we're sort of trying to build the knowledge base of the advisor and investor base over time. So this is the scorecard which we use to help our decision-making process as to whether or not we like to buy a bond. The score is out of 5, and it's broken up into 3 different factors: fundamental score, risk-reward score, and a liquidity and momentum score. Okay? It's very different to an equities framework. Now, the fundamental score, the top 3 parts being the credit rating, profitability, balance sheet strength, and the liquidity cash flow generation, that is all drawn from data from Bloomberg. Okay, so it draws all the latest financial data it can from Bloomberg, and it derives a score that's about 80% of the weight of that first part. Then the analyst or the fund manager that is looking after or doing the research will then put their own sponsorship rating. So how high is their conviction over an investment in this particular bond? Then they look at risk and reward in terms of what is the actual upside downside risk of the actual bond, and then the relative value against its peers, against the sector, and against the market as a whole. And then we look at liquidity and momentum. Okay? Liquidity is very, very crucial for us because we can confidently tell you that in the 8 years this portfolio has run, every single month we can liquefy the whole portfolio in 1 day. In 1 day, which we can't actually do in the equities portfolio, but we can do it inside this fixed income framework. So the equities team and the credit research team obviously interact in terms of companies that they're looking at. And remember, sometimes you have an equity investment which they don't like to buy, but it's a great bond investment because it's got very strong cash flows but no EPS growth, okay? And vice versa. So Frank, who sits on the senior team of 15, as well as Gordon, they have these bi-weekly meetings that discuss different research that they've been looking at in the last fortnight. Ladies and gentlemen, we face a problem. We face a fundamental problem going forward, whereby how do we derive justifiable yield for clients? So what you see up on the chart here is this is total global debt, corporate, government, everything. Okay? Now this was a month ago, so this is prior to the FOMC cutting 25 basis points last Thursday. And what you see here is that if I ask you the question, how many percent of the market pays 5% yield or above? The whole total globe. 3. And on top of that, we now face this issue where there's this dark part which is called sub-zero, which is 17 trillion and growing rapidly. So if we take out the sub-zero part of it for a second and we consider what's left in the universe, how much of that debt is investable for your clients and that you can justify to them after your fee and after the platform fee? Okay? Because this is the primary point, right? Clients come to see you to add value. And the problem is there are 2 risks going forward. 1, you continue to invest in traditional fixed income and you invest in the highest grade assets. And that's what everyone's done in the last 6 months. People have started piling more money into US treasuries or equivalents, thinking that is the safe bet, in the hope that the macro data is going to support that thesis. It is a very crowded trade, ladies and gentlemen. And the problem is that if at some point the US macro data that comes out is not as weak as what the market is pricing in for treasuries, and that snaps back, we're going to be in an environment where your clients are going to look down the barrel of losing money by buying the safest bonds possible in the market. And how do we deal with that? Because there are 3 challenges in fixed income. 1, fund managers traditionally are using the same body of research. So everyone's using Moody's, Fitch, and S&P as their screen to work out what is investment grade, what is safe, and what's dangerous. Now, if I was to propose to you that we transpose this theory and say that every equity manager that you invest with uses the same body of research, i.e. the same body of sell-side research, do you find that ludicrous? Because that's what fixed income managers do. They're using the same body of research to provide an initial screen to work out what is safe. Equity managers don't do that. Active equity managers don't do that. But what it means is that if you cannot add value via the fundamental research piece, there is one less very important lever that a fund manager can utilize to add alpha to your clients. The second thing is that we are in the low risk-free environment, which we now are facing an issue called return-free risk, okay, for your clients. And thirdly, prior to the GFC, for those of you that were practicing then, including myself, we saw fund managers profess that we can give you ultra diversification. And that ultra diversification is 500 corporate bonds in a portfolio. Very little tail risk, evenly distributed. And again, if I transpose that concept across and say, how many of you invest in an equities fund manager that holds 500 stocks in the portfolio? Because your next question is, how do you monitor those 500 stocks? In the same way you'd ask the question, how do you manage 500 bonds? Now, these three challenges, I'm speaking to you as a practitioner, as a fellow financial advisor who's completing his ethics exam at the moment. And this is what we actually face. What do we do? We then took, and again, this is the data before the FOMC rate cut last week, this is all the Vanguard indices across all the different asset classes and the amount of gross yield you will derive from them. We then assume, because we have to use asset-based fees for a like-for-like comparison, we assume 88 basis points is the average advisor fee, followed by 25 basis points on platform, and you end up with the net yield figure. Do any of your clients enjoy any of this at the moment? How are you explaining to them how you're getting them yield? Because the only other way is to dial up the risk. So you've got a lower allocation to defensive assets, higher allocation to growth, or a higher allocation to alt. However you want to put it. However you want to put it. This is the reality. So the universe that we're investing in is $800 billion, and the performance of the market overall, which is measured by the JP Morgan Asia Credit Index, or JASI, in our universe, has also been steadily performing well for investors. And the key issue is that we have to start dialing up the risk. What you may or may not know is that for those of you that have ever used a bank hybrid in Australia, you've already dialed up the risk. You've exposed your clients to quite significant risk, whether you know it or not, because that's subordinated debt. Ladies and gentlemen, I propose to you that if you have ever invested in a bank hybrid, if you invest in our fund, you will take less risk because we're further up the capital structure. We're further up the capital structure. Our clients have accepted an investment into bank hybrids because it's a bank and it's an Australian bank. That's about it. Okay? Other than that, they don't really understand what the risk and reward trade-off is. And if you look at the prospectuses of each of those, you'll see that it's gotten worse and worse for the investor. All we invest in, ladies and gentlemen, is senior unsecured debt. We do not invest in anything else. So how do we reduce risk? We reduce it by senior unsecured part of the market. We only participate in US dollar denominated bonds that's offshore. So whether or not we're investing in Russia or Mongolia or China, they are all US denominated offshore. We do not take any onshore risk for your clients because there are lower levels of liquidity and also higher levels of volatility, which we don't want to have your clients exposed to. We don't rely on any external research ratings because we think it's very, very backward looking. They don't provide a forecast and require events to occur before they'll change their rating, correct? Okay. So we find that's irrelevant. And finally, we use the AUD-USD as a hedge, okay, to reduce the volatility to your clients because generally speaking, over history, we've seen that the Australian dollar will depreciate against the US dollar when it's risk off. Okay? And when it's risk off, generally iron ore prices aren't strong, resource prices aren't strong, Chinese economic data is generally weaker, so on and so forth. So we become risk off. So Gordon uses that as a tool to reduce volatility, and right now we're 30% hedged against the US dollar in the portfolio. The three ways we have seen advisors use this fund as part of a diversified portfolio is in these three ways. And I want to caveat this by saying that the third one is how some advisors are using it, and please don't follow number three, because that is ludicrous in my personal opinion. You cannot substitute equity risk with bond risk, because those are two very, very different risks. It is more likely, and we're seeing the most common way that advisors are using it is in the second bucket. So alongside things like CTA funds, infrastructure funds, it's in the liquid alternatives bucket, because it is very lowly correlated against traditional fixed income as well as equities. But it pays a nice solid income which your clients are after. So the fund was set up in August 2011, which makes it right on just over 8 years of track record. $45 million in size. We cut the fees 2 years ago to remove the performance fee, so that we just charge a flat management fee of 113 points, and we pay quarterly distributions of 1.5%, of which in this whole 8-year period, ladies and gentlemen, we have not paid less than 1.5% per quarter. Never failed. Out of that $45 million, $4 million is my family's money, $2 million is Value Partners' money. Okay? And so we remain with a very high level of conviction that this portfolio will continue to kick the goals that we expected it to. The target volatility, ladies and gentlemen, for this fund is 7 to 8%. For the history of the fund, it is run at a volatility of just over 5%. And the reason is Gordon has managed that currency risk really, really well. The total annualized return of this portfolio is 10%. Okay? Divided by 5.3 makes it a Sharpe ratio of almost 2, which is very impressive for a high yield fund. Remember, ladies and gentlemen, that from 2011 all the way through to now, we've gone through 3 emerging market debt crises, one in 2013, one in 2015, and then one last year. So where we're deriving our yield is initially this cash yield of 8.8%. So that's where we start. And then we have a yield to maturity of 11.9%. I want to stress, ladies and gentlemen, that because this is Asian high yield or emerging market high yield, duration risk is not a risk that is relevant to us. Duration risk is a risk relevant to all other managers, but not to us, because we are fixed rate bonds. So our risk is credit risk, the company falling over. That is all that we're pretty much concerned with. And then people have told us, well, Jonathan, if you're fixed rate bonds, then when interest rates shoot up, then you're going to get hurt. And I go, but by how much? Because when you're generally invested in fixed rate bonds in developed markets, you're talking maybe 300-400 basis points of spread. Ladies and gentlemen, we're talking 600, 700, 800 basis points of spread above the risk-free rate. Therefore, providing far more cushion for your clients than any other fixed rate, fixed income strategy that you can actually get. So here's my premise to you. We currently hold 75 bonds in this portfolio with a cash yield of 8.8, with a yield to maturity of just under 12%, with a 2-year maturity profile. So in 2 years' time, none of these bonds default, your clients will make 12% a year, of which 9% is cash yield, 3% capital gains. Is that a bad outcome? Okay. Because while we can't predict anything on equities, we can give you some guidance onto what we can achieve for you in fixed income. Okay. This is the geographical and industry dispersion. So the first question people ask is, well, you've got 82% in China, Hong Kong. Historically, this is higher than what we've normally been. Now, the reason is this. Last year, I mentioned there was an emerging market debt crisis, and it was completely surrounded in China. So what happened was China's gone through a deleveraging process, as Frank has alluded to, that because of the stimulus package that launched in 2008 and 9, they created a lot of excesses in the system, including leverage. So they've been trying to reverse this out for years. And as part of the deleveraging, what do you have to do? You have to tighten the levels of liquidity in the system. And therefore, a lot of onshore Chinese companies couldn't raise debt onshore. So they needed to raise it offshore. So I always use the example. Let's say Westfield in May issued a bond in US dollars at 7% for 2 years. And then 3 months later, now, Westfield or a company equivalent to Westfield issued another bond for 2 years paying 9%. What happens to the bond that pays 7%? It goes down in value. That's what happened last year, which is why we saw this occur. That is the single largest blip that we could see in this portfolio ever in the 8 years. And that's how we also got 12.2 in the last 12 months, because the market went back to a normalized condition where China started to loosen again, increase liquidity into the system, and all the guys that were issuing bonds offshore went back onshore to raise their debt again. Okay? And that normalized and the bond prices went back up. It had nothing to do with the fundamentals of the company. And this is the point that I'm getting at. Nothing to do with the fundamentals of the company and everything to do with the way the market was and the environment in which we were trading in. Then the next question that everyone has is, well, Jonathan, you got 2/3 in property, and Chinese property, that's a taboo subject, right? That's the thing that blows up. That's the thing we see about ghost cities. What's happening with that? Now, ladies and gentlemen, you have to remember that the news flow we get about China and Australia is a couple of years old. So we're going to have to wait a couple of years before what really is happening today flows through to what we see. Okay? Because we end up seeing all these documentaries about China. Whereas everyone that has actually set foot in China, and there's a number of you in the room that I've taken to China on a couple of occasions, what you're seeing is very different to what you're reading in the news. Right? The metropolises are far more vibrant than what the news is trying to point out to you, and you've seen it with your own eyes. The thing is, at the moment, with real estate, if you look at the breakdown of the Chinese economy's GDP, 1/3 of it relates to property and property-related industries. That is the one part that we put to you of the economy where the Chinese government has total control over its destiny. China has no control over a trade war that is sparked by the US, and what the US wants to do this week, what they threaten to do next week, and what they actually do 6 months down the track is not within their control. But their property market and the consequences of a stable property market is their greatest concern. Because what happens is, if you have house prices stable and with house prices slowly going up, but the rate at which it's going up is not as fast as wage growth, what happens? Affordability increases. Then at the same time, if you have a gradual increase in property prices, you have an increase in wealth. Now, what have we seen in Australia when house prices go up? People have a higher propensity to spend. Nice cars, nice food, nice goods. Buying that thing that Frank was talking about with the auto dry cleaning machine. Okay? Upgrade of your living standards. China is stimulating its way out of these geopolitical tensions by effectively internalizing and mobilizing their population to consume more. Because, ladies and gentlemen, the trade war is not going away. Trade tensions in the world are not going away. While the US and China is the front page news, poster boy, we still have a South Korean and Japanese trade war. We have a US and Indian trade war. We have a US and Europe trade war. If you total the total amount of tariffs in force today divided by global trade, the value is about 8%, which is equivalent to around 1930 levels prior to the global depression. We are going into an isolationist economy whereby you need to evaluate each country you invest in and its ability to stimulate both fiscally and on a monetary policy basis and see whether or not they have the ability to mobilize their population to consume their way out of a depression. Pretty bleak, isn't it? But that is what we're facing going forward, and it's something that will flow into earnings as we go through the next couple of cycles of earnings for listed companies. But with real estate, the government is very supportive of it, and it is very, very stable. So for us, it is very low risk. Historically, we've had somewhere between 40 and 60%. We're now at about 2/3. okay? But is the safest part of the industry where we have incredible confidence over their ability to what? Pay us back our $100 in 2 years. That's what we're after, and that's what your clients want. This is our distribution history for the last 3 years. So you see that every quarter here we have not paid less than 1.5%. There are some situations where at the end of the financial year, you see that we've paid out quite high levels of distributions because based on Australian tax law, you have to remember that any capital gains inherent within the portfolio must be distributed out, okay? Because that's just the way trusts work in Australia for fixed income funds. There is no capital account, there's only an income account. You trade bonds, you make a capital gain, you have to pay it out at the end of the year. So for the financial year that just passed, we paid a grand total of 6.1% yield, very, very comfortably. Because the question then comes up and says, Jonathan, you've got a cash yield of 8.9. Why do you just pay us 6? You can just pay us more, right? Be a little bit more gung-ho. But the answer is no, we want to be conservative and pay you 6, right? Because the one thing that can swing the ability for the portfolio to be paying you out that full 8.89% of cash yield is if the currency swings against us. If the currency swings against us, we close the contracts, we lose money, that has to come out of this distribution. So therefore, currency swings us around a bit, but absorbed it through, we will get you your 6% distribution, and we have done that consistently for 36 quarters. I do want to say that there is no magic bullet. And the way that the world is going and the way that we build portfolios for our clients, we have to consider which part of the risk curve are we going to consider when we construct that portfolio. If you do a line of best fit here, this is just risk versus return, we sit on the left-hand side of that line. Okay? So no matter how you want to draw it, we sit on the left-hand side of that line. You are taking 5% volatility to get a 10% return. This is backward looking in an environment where rates were steady or slowly going up, and now we're in the reverse again. And this is total return. If you're wondering why everybody is stuck between 5 to 7% total return over the last 8 years, it goes back to the fundamental premise that I presented right at the beginning, that everybody uses the same body of research. If you use the same body of research, you have one less lever to play with when you're actually trying to add alpha and be a differentiator to your clients. So that's where we sit in the risk-return profile. I want to give you an example of a special situation bond. And this is Hong Kong Airlines. So Hong Kong Airlines is a subsidiary of the H&A Group. And as they're a subsidiary, they were going through a very bad period of negative PR. They were buying assets in Australia, New Zealand, sort of like the Japanese buying golf courses in Australia in the late 80s. Right? Left, right, and center don't care about price. So then the Chinese government picked up on this and told them, you start to rationalize your assets and start selling. Now, while this was all going on, Hong Kong Airlines, they had a $550 million US dollar debt issuance that was about to expire and mature on the 20th of January 2019. As a result of that, Red Intelligence came out and said, this company's never made a single dollar, and this bond's going to default. Bondholders will be burnt. So that report came out, and the bond went from $97 down to $80 in basically a couple of trading days. So we decided to pick it up at $80 because we thought that given the amount of negative PR they had, and it was only about 1% of our portfolio, given the fact that they had such negative PR, we had on good news flow that a China-backed bank, so not a commercial bank, but a sort of an SOE bank, was going to bail them out, which is exactly what happened. So we made the trade in early January, and I was very clear on this because I was actually sitting with Gordon with them in Hong Kong in January this year, and we just got back $100. Quick and simple 25% return. No yield, just 25% return. There's a lot of this dislocated things that are available in the market which we get for your clients over time. And it's been very, very good. The thing is, though, if you're still not convinced, just look at the spreads. What I'm comparing here is Asian investment grade versus US investment grade And currently you get paid about 20 odd basis points in premium to own that. And if it's Asian high yield versus US high yield, you're currently paid about 150 points of spread. Then there's China and US high yield spread difference, and that's over 200 basis points. It's sort of 260, 270 basis points of spread. It's not that this market doesn't move and is not dynamic over time, but at the moment, these are the spreads that you get. So that's the return. So then theoretically, you've got high default rates and high levels of volatility, right? You don't. There are lower levels of default in Asian high yield versus US high yield. It also exhibits lower levels of volatility than both US investment grade as well as emerging market investment grade. And when you look at the years to work out on maturity, because you don't want to be so far out this way because you don't know when you're going to get paid back your capital, right? And you don't want to be too low on the spectrum because you want the return. Where it is the risk return reward for us is really primary is around China B property, Asian high yield, and China double B property. All high yield, right? But there's nothing wrong with high yield. It's how you manage high yield that's important, which is why this whole theory around liquid alternatives for your clients is one area that we're focused on at the moment, and one way we're seeing advisors deploy this.